Welcome back, everyone. It may seem like a no-brainer to jump on the precious metals bandwagon, but your return on investment will depend on which stocks and ETFs that you choose to buy and, well, which you choose to avoid. Our producer, Jen Amos, asked the Weiss Research editors for their recommendations in the precious metals market. She joins us now with their responses. Jen, it's always nice to see you.
It's good to see you too, Jamie.
Well, let's jump right in. A lot of investors, they're going to be focusing on gold stocks when they jump into the market, so which company would be their best bet?
Let's start with one of the biggest names in mining, Barrick Gold. Sean Brodrick is recommending Barrick Gold in his new report, $50 silver and $2,500 gold. He points out that the stock has been trending higher for the past 18 months or so, and that it's now hammering against overhead resistance at about $47 a share. That tells us that buyers are getting impatient and coming in quicker and quicker on pullbacks to snap up the stock. If Barrick closes convincingly over that line of resistance, Sean thinks it has the potential to go much higher, along with the price of gold itself.
Are there any mining stocks that investors should stay away from?
Well, let's look at another one of the industry giants, FreeportMcMoran. It runs the biggest, most productive gold mine in the world in Indonesia, and it's been rallying for nearly 2 years. But as Tony Sagami points out, Freeport is also the world's largest producer of copper. In fact, about 3/4 of the company's revenues came from copper last year. Copper, of course, is an industrial metal, so it's much more dependent on a recovery in the global economy to sustain its gains. For that reason, Tony thinks investors would be better off with a pure gold play like Barrick.
Another way, of course, to play the precious metals market is through exchange-traded funds. What are the editors' picks and pans when it comes to using those?
That's Ron Rowland's area of expertise. Now, obviously, you can get into precious metals very easily by buying a fund like the Spider Gold Shares, ticker symbol GLD, or the Market Vectors Gold Miners ETF, ticker symbol GDX. But everyone knows about those. So for his pick, Ron looked farther afield, all the way to Africa, in fact. The iShares MSCI South Africa Index is heavily invested in the materials sector, in particular gold, platinum, and other precious metals mining. The strength in gold should also spill over into the rest of the South African economy, giving a boost to the fund's other holdings as well.
And I would also imagine here that the South African currency is getting a big boost from the run-up in gold prices, right?
Yes. As Bryan Rich pointed out, the currencies of most commodity exporting countries are doing quite well. Australia is an even bigger gold producer than South Africa. So if you want to use an exchange-traded fund to invest in a commodity currency, Bryan recommends the Currency Shares Australian Dollar Trust, ticker symbol FXA.
Any ETFs that investors should stay away from?
Well, Ron is warning investors about one particular exchange-traded note. It's a mouthful, so here goes. The UBS eTrax S&P 500 Gold Hedged Index ETN. Its approach is to hedge exposure to the S&P 500 with gold. That's a solid strategy, but Ron points out that this particular investment vehicle is extremely illiquid, and it often has days with zero volume. So he says that if you want to pursue this strategy, you'd be better off creating your own mixture with leveraged S&P and gold ETFs.
Okay, Jen Amos, thanks so much.
Thank you for having me back, Jamie.
Okay, coming up next, Sean Brodrick is standing by, along with John Brown of Euro Pacific Capital, Jay Taylor of Taylor Hard Money Advisors, and Andre Julian of Opvest Wealth Management. Will gold top its inflation-adjusted high of $2,300 an ounce? Is $5,000 out of the question? And what's the best way for you to play the rally? All those questions answered, plus a closing comment from Martin Weiss when Money and Markets returns.